Okay, good evening, everyone. I think we will begin. It's 10 minutes past 7, and we had wanted this meeting to be brief and to the point. So, karibuni sana. My name is Ricky Aguda, a member of SOCA, Society of Crop Agribusiness Advisors, and I believe this forum is largely attended by members of SOCA. So I will not dwell on SOCA, what SOCA is all about. I think that is very clear to all of us. I just want to go straight into the reason and the background for this particular meeting. So we appreciate that as crop agribusiness advisors, our members are in two spaces where it comes to matters of apologies for that. I think my internet connection dropped briefly. So as I was saying, we thought it would be great to have an overview of these matters of taxation. And of course, it's more of a discussion-based engagement. We really want to hear what questions or issues you may have. But to set the tone, one of the members of the Secretariat, Winnie Karanja, is going to make a brief presentation, and then, of course, we'll go into a discussion, stroke question and answer. So just to give a brief introduction to Winnie, I'm sure most of us have interacted with her on the phone. And Winnie Karanja joined the SOCA Secretariat last year in 2020, at the beginning of 2020. She has a background in finance and has been assisting us at the Secretariat with communications and matters of financial management. So given her background, we thought it would be prudent for her to give us a quick overview and then also address some of the pertinent issues. And as an example, I'm sure some of us have been following the issues of the minimum tax requirements, which was in the press over the last week with the High Court in Machakos suspending the same. And of course, the matter is now in court. So these are the kinds of things we thought it would be good to just get a clearer understanding of and see what they hold for us, whether you're in consulting or considering setting up your own advisory consultancy business. So without further ado, I'm going to welcome Winnie to take us through her presentation, and then introduce yourself further, Winnie, and then of course take us through your presentation, and then we shall get into some discussion and question and answer. Karibu sana.
Thank you, Ricky. You've said everything, so I'm just going to jump into the presentation so that we have time to discuss and I'll also have time to answer to questions that our members may be having. We'll start by a brief introduction. Then I'll go into direct and indirect taxes, but I'm going to focus more on the direct taxes. That is the turnover, individual and corporate taxes, and minimum tax. But we can't really ignore value added tax. So let's start. We all know what tax is, at least. This compulsory financial charge that we pay to KRA. This KRA is the governmental organization that is in order, that it has been mandated to collect the levies. And these taxes are used for government spending and public expenditures. The major classification of taxes are direct and indirect taxes. The direct taxes are those that you remit directly to the government as form of income tax. And income tax is imposed as business income from any trade or profession. Employment income for those of us who pay payee. There's rent income. We have investment income, among others. Next is indirect taxes, and those are the charges that you pay when you buy goods or services. You do not pay them directly, but they are included in the charge for goods and services. That is VAT, excise duty, and custom taxes. I did a composition so that you may be able to see, and from the pie chart you can see that most of government funding from taxes is from income tax, and VAT is the second highest, and that's why we'll also be discussing it. The rest are really small percentages, and income tax is the major. So let's go right into the next slide. So what is value added tax? VAT. It is tax that is collected by registered persons at designated point in the supply chain and remitted to KRA. It is tax on difference between what a producer pays for inputs, that is raw materials and services such as advertising, and what the producer charges for finished goods, that is final goods. And that's why we have the name value added, since it's after increasing or adding a value to a certain good or service. What are the VATable services or products? According to Section 5 and 6 of the VAT Act 2010, the supply of goods or services and on importation of goods and services into Kenya is VATable. The supply is a taxable supply and is made by a taxable person. That means that for you to charge value added tax, you must be you must be registered for VAT. You cannot charge VAT tax, and you're not a registered person to administer VAT. If you're also providing services in Kenya and your annual turnover is 5 million and above, then you're required to register and charge for VAT. However, there are instances where a business or a person may ask to register for VAT even when you've not really met the minimum requirement, the threshold of 5 million per annum. When do we file VAT? You're required to file VAT on or before 20th of the following month. For instance, the VAT for this month, the month of April, will be filed and submitted on or before the 20th of May next month. Failure to comply is an offense, and it attracts a penalty of 10,000 shillings for every tax period. That means if you did not file your VAT for last month, there is already 10,000 waiting to be paid by you. So there are several rates for VAT, and one is a general rated, and this you are quite familiar with. Every time you go to the supermarket, if you look at your receipt, there is usually a VAT charge There's also a charge of 8% on petroleum products. And also we have the zero rated, and we also have supplies that are exempt. There's a difference between zero rated and exempt. The exempt supplies include things like fertilizers, some agricultural produce such as tomatoes and onions, just to mention a few. For zero rated supplies, these are the basic food items such as wheat flour, maize flour, and so on and so forth. And we also have exported services, goods and services as part of the zero rated goods and services, and agricultural inputs also fall under zero rated category. To explain this better, I'm going to use an example. We're going to have a case study. We'll have a company, a consulting company. Let's name it ABC. And you might want to have a piece of paper and a pen, because I'm going to use this case study to explain all the other taxes. 1 minute to grab that. Assuming now you have your pen and your paper, we have a company called ABC. We are going to assume that the annual turnover is 20 million. Let's assume that the company expense is at 12 million. Let's also assume that the company has an employee. We can use the name Jane for the employee. And Jane's salary is a gross of 70,000 every month. And the company also has 2 consultants. They're independent consultants that are called whenever there's a contract that needs execution. So with that, now I can go ahead and explain. We'll start with registration. Is ABC company okay? Excuse me, Ricky.
Yes, Winnie.
I hope you're able to see the people in the waiting room so that you can admit them. We keep getting these requests to do so.
Yeah. But just please also increase your volume slightly. But yeah, I'm keeping a watch on people in the way.
Okay, thank you. Okay, we are going to check if, first of all, ABC company can register for VAT, and the answer is yes, because we said for a business to register, the annual turnover must be 5 million and above. So because our annual turnover for the company is 20 million, that means the company can register for VAT, and they can now start charging VAT on their services. And they will be required to remit the same to KRA afterwards. Next, we'll move to turnover tax. Turnover tax is a tax charged on the gross sales of a business, and it's payable by the people whose business, mostly small businesses, that do not exceed 5 million annually or are not expected to exceed 5 million in any given year. The charge is at 3% of the gross, not net, gross. And the advantage of turnover tax is that it is a final tax. This means that once you've paid turnover tax, you don't need to worry about any other income taxes, withholding, all those other taxes. You don't have to worry about them. You paid a turnover tax for your business, and that is the final tax. And another advantage associated with turnover tax is that business owners don't have to hire accountants or auditors because the payment process is pretty simple. Now you can even pay using your mobile phones via M-Pesa pay bill, and the business owners are not required to keep complex accounting records. They only require to keep a daily gross sales record for their business. So I had an example here, but we also go back to my case study. So how do you calculate for your turnover tax? Say, using the example on the slide, if this month, say you'll be able to make a turnover of 200,000, and this is well recorded in your sales book, then 3% of that will be your pay, will be what you'll be required to pay, which is 6,000. And this is supposed to be remitted by the following month, by the 20th of the following month. Let's go back to my case study using ABC consultancy company. Turnover tax will not be applicable for ABC. For one, because they have already exceeded the threshold for turnover tax, and ABC is not a small business, so they cannot file or they cannot even register for turnover tax. There are incomes that are exempt from turnover tax, and this is employment income. If you're employed, you're paying pay as you earn, so you don't need to file for turnover tax. If you have rental income, there's already a tax on that. And for most of us, because we are professionals and consultants, we also do not need to pay turnover tax. I know we are already paying withholding tax, and we get to that. So late filing for turnover tax is 5,000 every month. And if you submit your payment late, the penalty is 5% on the tax due, and interest on unpaid tax is 1% of the tax due for every month that you do not pay. I hope that is clear. Now, we already have ADVATs.
Sorry, excuse me, Winnie, maybe before you get into this slide, on the two previous slides, maybe if there are any questions on the value-added tax and the turnover tax, maybe if you went back to those two. From the participants, do we have any questions so that we can address them as we move along?
Hi, this is Angela. If she could repeat the value-added tax, because she was very faint, we could hardly hear her, if she doesn't mind.
Winnie? Anyone else with a
Any other comments or question before I repeat the VAT part?
I think you can proceed with that one. Yeah. Winnie.
Okay, so let's start again. VAT, value added tax, is a consumer tax charged on supply of taxable goods or services made in Kenya and on the importation of taxable goods or services into the country, that is Kenya. The tax is collected by designated persons at designated point in the supply chain and remitted to KRA. This means that for you to charge VAT tax, you must be a registered person, or your company must be registered for VAT for you to charge VAT, because you're basically holding these taxes for the government, and that's why you're also required to submit the same. I also mentioned, I hope I'm clear now.
Yes, you are. Thank you.
Okay. So the tax is, what do you remit to the government? It is the difference between your inputs, that is, for instance, raw materials and services such as advertising, and what you charge for the finished goods or the final goods. That is the difference. That is what you submit to the government or to the KRA. Here are some examples of what is vatable: supply of goods or services, and on importation of goods and services into Kenya. Number two, it will need that the supply is taxable supply and is made by a taxable person. The supply is made or provided in Kenya. Just to mention a few. We also have different rates for VAT, and we have the general rated rate. This is usually when you buy something where you're getting a receipt. Let me use the supermarket. You realize that if you check where you have your total, you see a rate for VAT, and that is the general rated sales. We're all familiar with that. Then we have zero rated, and exempt sales of VAT. The main difference between zero rated and exempt supplies is that the suppliers of zero rated goods and services can still claim their input VAT, but the suppliers of exempt goods are either not registered for VAT, and if they are, they cannot claim for input VAT. I'll give an example for zero rated. These are zero rated goods, and it will include things like the basic food items such as wheat flour. We also have agri inputs, and we have all goods and services that are provided for export. An example of exempt goods will include fertilizers. We also have agricultural produce that are unprocessed, such as vegetables. And for animal products, we have things like a live goat before you slaughter it. So, Angela, I hope you are able to capture that before I go into my case study.
Yes, thank you. I appreciate it. Asante.
Okay. So businesses that can register for turnover tax must meet the threshold of being able to make a gross revenue of 5 million every month. But you may want to register for VAT, and you can apply for that if your business is not yet making such a turnover. So going back to the case study, I'm gonna be really quick on this one. I had said that our company is ABC. We have an annual turnover of 20 million. We assumed our expenses to be 12 million, and thus we have a net profit of 8 million. The company has one employee. We named her Jane, and Jane is making a gross salary of 70,000 every month. And we also have 2 consultants. So in relation to VAT, ABC Consultancy Company already met the minimum requirement because the turnover is 20 million, and thus they should be registered for VAT, and they can charge VAT and remit the same to the government. So if you're registered under the VAT obligation, you're required to file your returns on or before the 20th of the following month and remit. If you do not comply, then there's a penalty for that, which is 10,000 for every month that you do not file. And if there are no further questions, Ricky, I would like to move to income tax.
There was a question on turnover tax. I think you've just touched on it, because the question referred to a sale if you don't make a sale in the month. But I think you've clarified on that you have to have met the sales in order to do the, I mean, to pay the tax. But I think the returns, if I got you right, did you say the returns still would still be made even though there were nil returns for that month, whether or not you had sales? Maybe just clarify on that.
If you're registered for a tax, that is, let me say, turnover tax and VAT, both of them, even if you did not have any transaction, but for VAT definitely will have a transaction. So for turnover tax, if you did not have any sales for that particular month, you'll still be required to file. You will submit a nil that will, so that you ensure you do not get this penalty for not filing, because not submitting anything will amount to non-compliance and there will be a penalty. So just submit a nil return. Okay, let's move to income tax. And income tax is wide, but I'm going to focus on the individual income tax and corporate. And right now, there are already these adverts all over from KRA that you should file your returns before the deadline, which is the 30th of June this year. And that is precisely why I would also like to share something on this. So income taxes are direct taxes, and they are imposed on incomes derived from business, employment, rent, and all that. And a person, for individuals, you're required to file your income tax for last year. Let's use 2020 as a practical example. You're required to file your income tax for 2020 in 2021 on or before the 30th of June. So I'm going to use the example so that I can be able to explain better. If you're a resident or non-resident and your income was accrued in Kenya, so that means you will be filing income tax if you have not done that. In this case, we're going to use our employee Jane, and we'll also use the consultants because we also need to pay that. For employees, you have already paid pay throughout the year last year. So what you need to do is get a P9 form from your organization, and a P9 form basically shows what you've earned for that year, the deductions that have been made, that is the statutory deductions, your monthly relief, that is personal relief that is granted by KRA, and finally the tax that you paid for that particular month. And the P9 form will show all that from January to December last year. Then what you need to do is to put together all the total gross pay that you got from your employment for the year. When you're doing your calculation, then you're going to also aggregate your relief, and you're also going to sum up your paid tax for last year. So in this case, Jane is being paid 70,000 every month. So the total income for her for last year would be 840,000. Then she's going to add the tax that she paid. Let's say what this would be. We can put an amount, just an estimate. You're going to use 25%, since that is what we were using last year. And at 25%, that means the tax that she paid last year was 210,000. Then we are going to also add the annual relief. For last year, you realize from January to March, we had a relief of 1,408 shillings every month. Then from April, because of COVID, the personal relief was increased to 2,400. So that in total will be 25,824. So we are going to get the total pay, get the tax that Jane should have paid. Then from the tax that she should have paid, we are going to deduct the actual tax that she paid, and also deduct the annual relief that was granted by the government. Any difference, if the difference is positive, that means Jane will have to pay X amount to KRA. If the difference is negative, that means that she has paid more tax than she should have in that particular year, will be refunded, or rather refundable by KRA. I would like to know if there is a question before I move to consultants. Okay. For consultants, what is deducted is the withholding tax. You do not pay, you pay withholding tax. So when it comes to your individual income tax, you're going to also take your total income for that particular year. All the money that you paid from different consultancies. You're going to put all that together. And for consultants, you're allowed to deduct expenses, say maybe fuel, accommodation, and such. Then after you've deducted your expenses, we are going to have taxable income. And from that taxable income, we are going to calculate your tax payable for the year. From the tax payable, the amount that we got, we are going to deduct what the tax that you actually paid for the year. That is the 5% that were withheld. Then we are also going to deduct your annual relief, just like what we did in pay. And then the difference will be your tax that will either be payable or refundable. That is, if the figure we get is positive, that means you have to submit that money to KRA. If it's a negative, that means you have paid more tax, and that amount will be refundable. What happens if you will not have filed your taxes by end of June this year for last year? There will be a penalty of 2,000 shillings or 5% of the tax that you are to pay, whichever is higher. What happens if you file your taxes and there is an amount that you should pay and you do not actually pay? Then there will be an interest, 5% to be precise, on the amount that you did not remit. And if you do not remit it for, say, 2-3 months, then every month that amount will increase at a rate of 1% until such a time when you pay all your taxes in full. And that's all for individual income tax, unless there is a question.
Thanks, Winnie. I think maybe just so that we have some clarity there. When you talked of consultants, I think we needed to be clear, because I may be thinking of the consultant as the company that is doing consultancy, or I may be thinking of the individual. So which particular scenario are you referring to when you said for the consultants and the issue of the withholding tax, even as you do your computation? Are you talking of the consulting, like if I run a consulting company, or are you talking of me as a consultant, an individual?
For this first one, I'm talking of the individual, not the company. We'll come to the company next. But for this particular one is for individuals. Legally, remember that a company is a person. So there is a person, even the owner of the company will be treated as a separate entity from the company. So there is a company, the legal entity, and there is you, the individual, now the consultant. So when it comes to tax, you will be treated separately.
Thanks, Winnie. Just checking again for if there's any questions. Please use the chat box. Or you feel free to raise your hand, and then I can I'll pick out on you if you've got a question. Otherwise, Winnie, please proceed, and then we'll come back to take questions in general.
Okay. Let's now discuss the company. and the company will be taxed under corporate tax. And corporate tax is a tax on the profits. And this profit is after you've deducted the allowable expenses. What do I mean? Your cost of sales, which may include administrative expenses, there's selling and marketing, there's research and development, there's operational costs, and so on and so forth. Please note that companies that are based outside Kenya but operated in Kenya or have a branch in Kenya will pay for corporate tax as well, as long as the income was accrued within the country. Going back to our case study, ABC, our company, had a turnover of 20 million. Our expenses allowable in this case, we had 12 million as our expenses, and our net profit is 8 million in this case. So for corporate tax, which is 30%, but if we use, let's use last rather the current rate, which is 25%. So that will be 0.2. Multiply that by 8 million, so that we are able to get the tax that ABC will pay, and that will be 2 million. So after deducting all your expenses, now this is the company, you sum up your incomes, deduct your expenses, then you'll be able to have your tax payable for that particular year. And in this case, our tax will be 2 million. And I had a question from our email, which I'm going to respond to now. I believe this is the best type. It was about partnerships, and partnership do not pay corporate tax. The profit of the partnership is distributed among the individual partners in the ratio of their ownership, or in the ratio in which they have agreed to share profits, and then that will be taxed when we are calculating the individual income tax and not as a corporate tax. And that's all for corporate tax.
I think there's a question. There's a question on the chat from Esther. Esther's asked whether there will be tax for individuals and companies. Esther, maybe you just want to elaborate on that question so that it can be addressed, if not already, before we move on.
Okay, my name is Sister Kimani. I was just asking whether the company will pay for the taxes and also other taxes for the individuals. But I think from what you have explained, it sounds like whatever is being paid to the individuals may be in the expenses, and then if there's any profit, then more taxes will have to be paid, if I'm correct.
For an individual will be responsible for filing and payment of their own taxes. And for a company, what a company will deduct is its expenses, and salary is one of the allowable expense for a company. So whatever a company paid to its employees will be deducted from the revenues, And then now the profit will be charged to the rate at which the corporate tax will be paid. Esther, is that clear? Did I shed some light?
Yes, but I was also wondering, how do you deal with a case where the directors may decide to pay themselves very high salaries so that there will be no much profit?
Well, different companies have different ways of determining that salary, and KRA can't really come and say that this employee is being paid too much money. Also remember that salaries are also subjected to payee. So KRA is still collecting money from those high salaries that the directors are being paid from. I think for KRA it won't be an issue if the directors are being paid so much, as long as the taxes are being filed and payments are being made.
Okay.
And I think that's an interesting question from Esther, which also even brings in the element of the minimum tax to some extent. Because if I get part of the logic of that question, Esther, you're looking at a scenario where the company is basically making next to no profit. And it's paying the directors are being paid, or the business owners are being paid a high salary, and while the company is still running, it may not be making, it may even be making a loss. So maybe I think that really links.
Yes, that's what
well.
I was.
Yeah, I think that links very well to the issue of the minimum tax, which, if I'm not wrong, is coming next.
Okay.
Yes, Esther, relating to your question, and that was one of the reasons why minimum tax was being introduced, even though now the case is in court, and we are waiting to hear what happens on the 19th of May on the same, because also KRA went ahead and appealed on the decision to hold that tax, and so we will wait and see the decision that we get. But part of the reason why the minimum tax was being introduced is because we have businesses that have been in operation for quite some time, but they are still making losses. And some of these losses could be, like what you said, created, and not really because the company is not making money. So let's go into it. The minimum tax is been all over and it was introduced just last year, and it is payable on the gross turnover of the companies. And gross means that you do not deduct any expense. It's all the revenues that you make, and then 1% of that amount will be remitted to the government. Whether you make a profit or not, you still have to pay minimum tax. I'll also introduce another element of installment tax, because minimum tax and installment tax are an advanced tax. This means that you estimate this tax for both of them. It's an estimation. Then you pay it in installments. Even for minimum tax, if we are really going to continue filing or paying, it is being done in quarters. So for 4 quarters, you have to estimate what you're going to pay for that particular year as tax, and then you can pay it in quarters, the 4 quarters of the year. So where the installment, let me first say what installment tax is. So installment tax is paid before the year of income is over and before the accounts of business are prepared to establish the actual tax payable. How do you calculate or estimate installment tax? You use the prior year basis. For instance, if you're calculating your installment tax for 2021, you're going to use 2020 as the base, and you're going to take what you paid last year, 2020, and then multiply that tax that you paid by 110%, sorry, and the tax that you will get is what you use as your estimate for installment tax payment. For those companies that maybe made a loss last year, and this year, by the look, you can maybe tell you're going to make a profit, then how do you estimate your installment tax? This you'll just estimate. Just calculate maybe with your accounts department or finance. You estimate how much you think that the company is going to make, and that will be the payable tax thereon. So where the installment tax is higher than the minimum tax, then the person shall be required to pay the minimum tax. What do I mean? Using our example, our annual turnover is 20 million. Our net profit is 8 million. If I do 1% of the turnover, that means my minimum tax will be 200,000. If I use installment tax and use the profit that I made, not the profit, the tax that I made, that means using 30%, my tax was 2.4 million. So if I multiply 2.4 million by 110%, I'm going to get 2.6. So my installment tax for the year will be 2.6. But my minimum tax for the year will be 200,000. That means that I'm going to apply the installment tax since it's the one that is higher. But if my minimum tax was higher than the installment tax, that means I would have paid the minimum tax. And that is how minimum tax will be coming in for corporates or businesses, so to speak. There are incomes that are exempted from minimum tax, such as employment tax. That is because you're already paying pay as you earn. There's income, residential rental income, because there's already a tax on that. If you're paying turnover tax, you also don't need to pay minimum tax. There's also income that is subject to capital gains tax. There's also income of extractive sector. And I'll now move to the question and answer session. That was the brief session that I prepared for you guys, basically touching on the basic taxes. So I can take questions or we can discuss. Thank you.
Thank you very much, Winnie. Maybe I'll just start by taking you back to the explanation on the taxation for the consultants. I think maybe if you just give us an example similar to what you did for, I think you made an example of Jen who was employed by ABC. So if say, and I noticed we have two Angelas. So if say Angela is contracted by ABC and to provide a very specific, assignment as a consultant, or even contracted by any other company because she's an agribusiness consultant, and the fee that is agreed for that particular assignment is, let's call it 100,000. Maybe just give us an idea of what happens from the point of that fee that is agreed to Angela's tax picture.
Okay. I think I'm going to show the calculation. Is the gross will be 100,000. Yeah. This is consultancy, not employment, Ricky.
Yes, consultancy.
Okay. So if Angela got a contract fee is 100,000, that means that Angela will be paid less withholding tax of 5%. So this is the amount that Angela will receive by the time she has finished that contract. This is the money that she will receive, 95,000. So now when she's filing for her income taxes, she'll say that her gross income, let's say contract fee. So do that, her gross income will be 95,000. Then now we come to expenses. For her to generate this income or to perform, let's say maybe a training, there was a training, for instance, what were the expenses? We can say there was travel, say that maybe went to 5,000. We can say there were meals. We can do 3,000 for meals. What else can we add? Is others. Let's say others. Maybe we can do this at 6,000. So for her total expenses for that particular assignment was 14,000. Okay, going to be this, and her net from that assignment will be 81. So 81,000 is the taxable pay. This is what we are going to tax. So if we use the rate, let's do 25% of this, even though there is a graduated scale rate that is supposed to be used, but since it's just an illustration, we go straight to the highest, which is 25%. So this we're going to multiply by 25%, and then we'll see what tax that Angela should have paid. So Angela should have paid 20,000 as the tax. Is it payable tax? Tax payable. Tax payable. It's 20,000. But there is what Angela actually paid. So what did she pay? We had this, so we are going to deduct. I think maybe I should add another. Yeah. So we say less. So what are we deducting? The withholding tax that was deducted when she was being paid, which is 5,000. 5,000. And then we are also going to deduct the relief. And I'm going to use the one for last year for that whole year, which would be 25,824. So then we can now see this is tax payable, and then what is it that Angela is going to pay, and we can just sum this up, and we see whether Angela is going to pay or she has a refund. So you can see initially Angela was to pay 20,000 for that year, but then she had already paid a withholding tax of 5,000, and there's a personal relief of 25,000. So that means Angela will be getting a refund of 10,574 from KRA. I hope this is good.
Angela has a question.
Okay.
What I know you mentioned there are some allowable expenses, and meaning there must be some that are not allowable.
Yeah.
Can you give us example of some allowable expenses and some unallowable ones?
Mm-hmm.
Because it looks like if I'm doing a consultancy and the 5% is taken, it's just like it's prompting KRA to tell them Angela is coming. There's man, Angela has been paid. Kuna pesa mtapewa at the end of the year. Yes?
Yes.
Yes, it looks like withholding tax is just an advanced tax. It's just for KRA. It's like I have paid KRA a little bit of money and alerted them I did business. Sasa ngojeni ingine.
Yeah.
But maybe you can give us examples of allowable expenses and those unallowable ones. Tafadhali.
Okay. For allowable expenses, will include examples would be like salaries. Like for instance, if Angela, for this contract, if you hired somebody else to help you with this particular contract, that expense is allowable. This also trying to see if I can be able to group everything. Okay, maybe I should define what is an allowable tax deduction. This is the amount you paid for something for which assisted or you expensed that item so that you can be able to earn your income. And now for this particular example that we have here for Angela, traveling assisted you earn your money, because if you didn't go to that particular place and train, then that means you would not have been paid for that particular contract. You also needed to eat so that you can have energy, and other expenses could be maybe stationary. You needed materials for training, and like for salary, maybe you needed help for that particular job. So any expense that is related to that income that you're earning is allowable. For disallowable expenses are expenses that are accounting. I would say that you did not really incur any cost. And the best example would be depreciation or amortization. When we are keeping books or when we are doing books, there's an expense for your laptop. You have your laptop, and there's a rate that your laptop is going to depreciate at 12.5% every year. You're not really losing this money. Yes, your laptop is depreciating for sure, but this money is not coming from the business. And so these amounts, when you're doing your taxation, will not be deductible.
Okay, it's understood. And say Angela does this consultancy for 100K this month. And then she goes for like another 2 months without one. And then the next one she gets is probably June. When should she make this tax payable?
Okay. Every time you get a contract, when you're being paid, withholding tax will be remitted. Even if it will be after 2 months or 3 months, that will be remitted. So you will only put all your incomes together. Like for instance, for last year, whatever income you earned in January, say February you didn't, then you got another contract maybe in September. So all the income that you got from last year, it does not matter which month. You're going to put them together when now you are filing, when you'll be filing your income tax.
Yes.
Deduct your expenses for both or the three, or deduct for all of them. And then you're going to have your taxable pay. Apply the applicable tax rates. And then you do you deduct your withholding tax that you are deducted then. Put in your relief, and now you see the difference.
Okay. Okay, understood. Thank you.
Okay.
Great, thank you, Winnie. I think there's one other question on the chat box. I've seen. Okay, there's a question about care actually refunding. Let me not laugh about that. If you will tell us if it happens. I've never seen a refund. I wouldn't mind one. And there's also a question about the allowable expenses, whether it applies to limited companies as well. And I believe this is the case because the scenario you are painting out, while it was for an individual, you do have companies that have employees who would probably be doing the same. So the company would also have allowable expenses, which is what makes up the P&L for the company. Maybe you could just give a quick response to the issue of refunds from KRA.
Okay. It hardly happens. They do, but hardly, because they always assume that the next tax period you will have the liability to pay, and then you can offset. So the tax credits are mostly there. They will be in your iTax ledger waiting for you to have a liability. Then instead of you paying, you just offset. So refunding, it doesn't happen. It's really, really difficult to have one. You will just offset in the next period. That's what I would say. The other question was, I think I lost that.
It was on allowable expenses for companies, and I think I was just making a contribution that it would be the same as what you've outlined for individuals. Just that the way the company makes up its P&L and what it is also justified in capturing under the expenditure, the same rules would apply. But you could also clarify on that.
Yeah, both allowable and disallowable expenses will apply for both. And for companies, the finance department or your accountant in the company already knows what is allowable and what is not allowable. It's just what I explained to using this example here. So yes, the treatment is the same for allowable and disallowable expenses. The treatment is the same for both individuals and companies. Any other question, Ricky?
Not at the moment. So I think we have about 6 minutes to go on this particular segment. And as I said initially, the purpose was just to brief us as advisors and as consultants on the tax regime. We've seen, I think, even from the questions that members would benefit from, I think, unpacking some case studies that would, put in all these different elements. So I think we should actually plan for a follow-up session where we can look at very specific case studies that would even make this much more clearer for us, because I'm sure as we continue to digest this, then the questions would come. I'm seeing Angela Limo on the chat box, appreciating the presentation and the way that you have broken down the issues of tax. Angela, thank you for that comment. At least it wasn't just the penalties, because I had a lot of the penalties in case one doesn't comply. So it's good that apart from the penalties, we're also getting to see the other side of the coin. In case anyone else has any question, please, as we wind up for this particular segment, it would be great. You can unmute yourself and ask your question, or use the chat box. And of course, we will share the recording and the presentation that Winnie has made, so that you can access it. And I would request if you could share your email address. I think Angela Ngede, I'm not too sure we have your email contact. And anyone else whose email address you may not have, you could always drop your email address on the chat box, so that we can share the proceedings from this evening with you. So Winnie, back to you. Maybe some closing remarks on
Ricky, if I may, I have one more question for Winnie.
Okay, please go ahead.
Thank you. Winnie, in your opinion, in your professional opinion, is it better for us consultants to take on contracts with our individual names, or is it better for us to register companies, limited companies, or sole proprietorship, or whatever, and deal as companies? What in your professional opinion would make more sense?
Okay, thank you, Angela. For taking a contract, first let me address the issue of personal or sole proprietorship. It's one and the same thing. If you say have a business called, maybe let's still use ABC, but it's a sole proprietorship. The owner is Angela. So for sole proprietorship businesses, you cannot differentiate the business from the owner. So in cases of liabilities, it will not be the business, it will be Angela. And so for tax purposes, it's still the same thing. It's one and the same for sole proprietorship. You're the owner, you're everything. So even your personal property, for instance, if the business got some debts, will also come and sell maybe your car to cover the debt of your business, because you cannot separate a sole proprietorship from the owner. For limited companies, the limited company is a legal entity. So there is a difference between the owner of the company and the company itself. So for liability reasons, it's better to have a company than to take contracts as a sole proprietor. But for tax purposes, there's not much difference. Let me say that there's not much difference, because even for companies, when they are getting contracts from other companies, they still have that withholding tax. But the only reason I would maybe advocate for companies more than sole proprietorship would be for liability reasons and not really tax.
Okay, thank you very much.
Great, thank you, Winnie, and thank you everyone for your indulgence and even your questions. Oh, Francis.
Hi, Ricky. I'm back now. Just a quick question, and for purposes of clarification, I thought there's been and I'm asking this so that it's clarified even as we go along. I thought the Companies Act in the recent months changed such that even as a sole proprietor, you can have a limited liability company. But I'm just asking so that there's probably more work put into that and clarification. But that was my understanding. So it's more of a comment and a question at the same time. Thank you.
Okay. Yes, Francis. There's that. There was that change was made. And it means that you, as Francis, you can register and own a company by yourself, and you also you can decide to register it as a limited liability company or a sole proprietorship. So yes, you can go into business as the sole director of a limited liability company, which totally differs from you being a sole proprietor.
Thank you.
So
Thank you for that clarification.
it just means you can have a company with one director. Before, it always used to have multiple directors. Now it just means you can be one director, you yourself, and you're still a limited company.
Yes.
Okay. I'm just checking any other last questions before we wind up. I believe we're open to receiving feedback from you. We had shared our email address, and I'll put it on the chat box again. If we were to have a follow-up session, maybe just share with us any specific issues or other aspects on taxation that you would want us to capture on. We would appreciate that you share your questions to the SOCA email address, and we can always capture that and see how best to put together a follow-up segment. But for the time being, I want to thank you all for your time. Thank you so much, Winnie, for elaborating and informing us on these different aspects of taxation. I trust they've been useful to everyone, and we do, of course, wish you all the best with handling your tax matters. Please do get in touch with us via the info@soca.or address, so that if in case of any very specific issue, we can always make a follow-up with you directly. So thank you. I wish you all a good evening. Stay safe wherever you are, and God bless you all. Thanks and good night.
Thank you. Nice evening, everyone.
Thank you and good evening.